This is episode 97 of the Rohit Radio Show, and in this video, I want to discuss how I add a stock to my radar screen. So, for example, I am tracking a certain group of companies in the stock market, and if I want to add a company to my radar or my circle of competence, how do I do that? So, there is a 5-step process that I follow, which I want to discuss with you here. Number one, I use certain filters. So, for example, I am looking at a company which has got little or no debt, which has got a high return on equity, which has got high profit margin. Certain filters that I put in the screener application, and I get a list of companies. Out of those companies, if I'm interested in a particular company, say for example, I want to invest in Colgate sometime in the future. So I pick that company based on these parameters. Before I pick the company, that company should satisfy the criteria that I have given for those filters. So let's say Colgate, which is the toothpaste company, fits into that criteria. So that is step number one, filtering and picking one stock which I might want to own in the future. I am just adding it to my radar. I am not buying the stock. I am just adding it to my radar. I am just watching it. It is coming into my watch list, which means that I'm going to track this stock throughout my life. I want to have a look at this company and I want to buy the stock when the price or the valuation is attractive. So step number one is picking that stock which I might want to own in the future because I understand that business. Number two, put the financials on an Excel sheet. So what I do is, let's say I look at Colgate company. I download the past 10 years of financials of the company. So I download 5 annual reports, past 5 annual reports alternate, because one annual report has got 2 years worth of numbers. So I download 5 annual reports. So that is 10 years worth of financial history. I put those numbers on my Excel sheet. So I put those numbers in a model that I have prepared. So that is step number two. I want the numbers because if the company is good, if the business is great, it will automatically show in numbers. So first I want to look at the numbers. Step number three is ratio analysis. What I have done is once I put the numbers, I have already put formulas in the Excel sheet which calculate the ratios for me. For example, the gross margin, net margin. Anybody can do this. This is a very simple process. I would like to recommend a book to you here, which if you read that book, it will be very easy for you to prepare a model that I have prepared. That book is Warren Buffett, An Interpretation of Financial Statements, written by Mary Buffett. Study that book carefully so that you can prepare your own model. The reason why I am not sharing my model here is because my model is suitable to my temperament and my kind of companies. Every investor is different and every investor's priorities, every investor's way of looking at numbers is different. So you have to prepare something that you understand and which you have a feel for. I cannot work on someone else's model. Similarly, you will not be able to work on my model. It is something that I have prepared for myself and I understand it the best. So that number three is ratio analysis. These ratios, the gross margin, pre-tax operating earnings, net margin, net receivables percentage, inventory turnover, cash conversion cycle, return on equity, return on invested capital. I calculate all those ratios. In fact, those numbers get automatically filled up as I am entering these past 10 years worth of data. It takes me around a couple of hours to fill up that entire data. But I invest those 2 hours because this is a company that I really want to own in the future. I am not owning it now because maybe it's overvalued or some other reason because of which I am not buying the stock now. Number four is summary sheet. Let's say I have an Excel sheet and for every company I have one sheet. I have one sheet for Colgate, I have one sheet for Nestle, I have one sheet for Britannia and so on. There must also be one sheet in my Excel framework where all of the data of these companies is summarized into one particular sheet so that I can compare these companies. So for example, Britannia might have a return on equity of 20%. Colgate might have a return on equity of 40%. That tells me which company is making a better use of capital. Although these two companies are selling different products in different sectors, their markets are different, but money is money. I have a choice whether I want to invest in Britannia or Colgate. So I have a choice. I can compare any two companies in any two sectors. Nobody is stopping me from doing that. I want to see which company is making better use of the capital that they have invested in the business. So number 4 is the summary sheet. I have a summary sheet where I am able to see the numbers of all the companies in a condensed format so that I can compare these companies. And I don't want to track more than 25, 30 companies because a lot of companies are there in the market which do not meet my criteria. Basically, I am looking for companies which have little or no debt, which have good free cash flow, which have a long dividend history, which have been in business for more than 5 decades. These are certain filters that I use to extract companies which are already doing very good business. And I might not buy them now, but I might buy them in the future. Let's say there is some recession and the stock market crashes, then the valuations might become attractive and then I may pull the trigger. Number 5 is updating this sheet every single year, because I am only looking at this sheet once per year, right? Because the data for the next set of data to arrive, I have to wait for the next annual report. So it becomes very easy to maintain. I don't have to look at this sheet over and over again. I just have to, once I have all the numbers in place, I just have to keep tracking the market value of the company. And as long as the market value of a company is above a certain point, I'm not going to buy the company. If it reaches within my valuation criteria, then I am interested. This is the 5-step process that I use to add a stock to my radar. And that is how I track my investments. I track my watch list. Number 1 is I use the filter to pick a company. Number 2 is I put the financials in an Excel sheet. Number 3, I do some ratio analysis, the basics. Number 4, I have a summary sheet where all the data is available. And number 5, I update this framework every single year. And this model is only for me because I have prepared it for myself. I understand it better, and I encourage you to prepare your own. While preparing the model itself, you will learn so much about a particular company. Don't work on someone else's model. Prepare your own. Do your own due diligence. That will help you in the long run. Thank you so much.